Well, let's get talking today. The Finance Act 2022, signed into law by President Mohammed Buhari, has ushered in a new era of tax governance in the country. Is proposing an amendment to some tax and fiscal laws to promote economic growth, attract foreign investment, and increase government revenue. The act, which amends 13 different tax and fiscal regulations, was enacted in accordance with Nigeria's macroeconomic policy reforms and to stimulate revenue mobilization for the purpose of budget implementation. Other key areas include tax administration, international taxation, financial sector reforms, and tax equities and public financial management reforms. Well, let's get to understand in-depth analysis again and the impact of this act on businesses and the economy at large. I have joining me live in our Lagos studio. He is the managing partner at Koju Professional Services, Mr. Olakboju Bamidele. Good afternoon. Thank you very much for joining us on the show.
Thanks so much.
It's really good to have you on the show today.
Thanks so much.
Now, it's a little bit technical, and that's why we have a professional like you in the house. Gains on disposal of shares are to be taxed, and that's at the rate of about 10%.
Yes, exactly.
Are there expectations or exemptions, I beg your pardon, are there exceptions to these rules? And what are the implications, of course, to investors, government, and others?
Thanks so much for having me once again. Now, capital gain tax, section 30, subsection 2, provides that there should be a 10% tax on shares, Nigerian shares held in Nigerian company that are, sold at 10%. Now, but the three exceptions provided by section 30 subsection 2 are: number one, where shares worth below the sum of 100 million in any Nigerian company are disposed within 12 consecutive months, and returns are properly filed as required by the law. That's the first one. The second one is where investment in a Nigerian company is rolled over within 12 months of disposal. The second exception. Then the third one is where lender transfers shares to borrowers in accordance with the SEC rule 2013 as amended. Those are then the implication of this to government is that: number one, there are more revenue to government. Number two is that investors are encouraged to invest more, to roll over their investment. But number three also is that I noticed that high net worth investors are targeted in this. So that's why the threshold of 100 million. So they are targeted. Then number four is that stockbrokers might be kept busy, because at some point they might be asked to produce record of of people that they help to sell shares here and there. So these are the implications of capital gain tax.
I'm also looking at the company income tax, which contains the highest number of amendments, about 14 of it sections in the FA. Now, what are the key implications of these two, and of course implication to taxpayers? Government really is looking for money.
Yes. Thank you so much. So from this amendment, like you just said, there are 14 amendments under SSAT, Company Income Tax Act. So I will just go over the key ones and their implications to the business environment. Number one is section 13 subsection 2, FRS to assess the profits of foreign digital companies to company income taxes. So non-resident suppliers of digital services with significant economic presence in Nigeria shall have their profit they earn from Nigeria subject to company income tax henceforth. Then section 30 subsection 1A2, describe FRS power to assess the foreign digital companies to income tax on the basis of turnover. Now, this is not new, but what is new there is bringing foreign digital companies into this bracket. All right. So, and the conditions upon which FRS can subject the turnover, to company income taxes is when, in the opinion of FRS, there is no accessible profit reported, or it is less than what is actually expected. So they are at liberty to assess the turnover of the digital company to tax on the basis of turnover. Now the question is, the provision says that it should be at a fair and reasonable rate. Now the question is, what is fair and reasonable? So this provision brings into the hand of FRS to use discretion, to apply a rate on turnover. All right. And if you ask me, in practice, it's actually 6%. So I believe that government going forward should be able to make a declaration, authorities should be able to make declaration as to what exactly rate should be applied, in this instance. Then another section 16 talk about taxation of insurance companies. Before now, certain definitions, are not clear when it comes to administration and computing for insurance taxation was not clear. But right now, there are clearer definitions and basis to compute taxable profit of insurance company, both life and general insurance. So, for example, you have gross income and gross premium, now well defined, which I believe is an incentive to people to put in more money into the sector. Then number two is that insurance companies are now required to submit a copy of the actual valuation report to FRS within 3 months after it has taken place. This was not so before. The third one, the key third one under taxation of insurance company is insurance companies are now mandated when they are filing their returns to have to hit all the details of their insurance agents, loss adjusters, insurance brokers, and all the deals they have with them in the particular year, so as to be able to block loopholes where government have been losing revenue. So in essence, for taxation insurance company, investors are more encouraged to put in more money. It's not clearer now how to compute the taxes, but at the same time, they have more burden on what to file when they are filing returns. All right. So another one, very key important section is section 23, subsection 1C, which talks about companies that provide educational services shall be liable to CIT. Educational institutes before now, are tax-free as far as income taxes are concerned. But right now, they are going to be paying taxes. And you're talking about schools, they are going to be paying taxes. But there are two exceptions to this. Now, if a company is set up as an NGO or a charitable organization, and what you call surplus or profit, accruing are ploughed back, there's evidence that they are ploughed back to promote that cause, then definitely they will be exempted from the CIT. Then the second one is if that school or the institute, the education institute, is classified as a small company, then they will enjoy the benefit of small company where you pay zero tax until you reach the threshold of 25 million. So that's as far as that is concerned. Then another section, key section, is section 23(1), subsection Q, talks about withdrawal of tax exemption on export profit of upstream, midstream, and downstream petroleum companies. Prior to FA 2021, there's this general relief for companies when you export products outside and you now take the proceed to buy equipment and plant and bring back to Nigeria, you'll be exempted from company income tax. But because of the PIA, Petroleum Industry Act 2021, that PIA changed the game. Because now, certain companies that operate in upstream, midstream, and downstream petroleum have been brought, as far as taxation is concerned, from PPT, Petroleum Profit Tax, under SSAT, company income tax. So with that, they can no more take that relief they used to enjoy under this particular section, so they are being excluded. All right. So now, another one is section 31, which talks about capital allowances. So there are about 4 restrictions now on capital allowances. Capital allowances are what you use to reduce your, taxes when you are computing. So now, let me just quickly mention that. Number one of them is that only capital allowance on assets that was used to generate an accessible profit shall be allowed as deduction when computing for income tax. In other words, if the asset is idle, doesn't contribute anything, you cannot take capital allowance relief on that asset to, reduce tax payable. The second one is where capital expenditure is incurred to generate both taxable and non-taxable income, and the non-taxable income is greater than 20% of the total income, the capital allowances shall be prorated accordingly. That's straightforward. So where you have a mix of income, more than 20% is non-taxable. So in that instance, you cannot take 100% capital allowance. It has to be prorated according to the ratios, of the taxable and non-taxable income. Then the third one is the accessible profit of small and medium company must be matched against the capital allowances on qualifying assets for the year. Any unabsorbed allowances shall be carried into the future. Ideally, I think that's very ideal. Where you have a small company that is not going to pay company income tax, why will you begin to accumulate capital allowances, what you call tax asset, and carry into the future? So what this section has done is to say if you're a small company, compute your accessible profit, match it with capital allowances on your asset. Whatever remains residue, take it into the future. So the fourth subsection 1D here says that pioneer companies that enjoy pioneer status under the Industrial Development Act, they are exempted from these restrictions. All right. So then section 33 subsection 2 talks about reduction in minimum tax rate. The reduction of minimum tax rate from 0.5 to 0.25% of turnover, less frank investment income, will apply only to any 2 consecutive accounting period between 1 January 2019 and 31 December as may be chosen by the taxpayer. I know there's a story around this. So the previous FA, there was a drafting error, as to this, when government granted a relief because of COVID. So because of that problem, now this particular section has come to, in a very fair way, deal with it. That a taxpayer that qualifies, for this, I mean, you have minimum taxes for those 3 years. You can now have the power of election to elect which of the 2 you want to, use to take the relief of 50% on the minimum tax. All right. So, but I'm looking forward into the future when government will take out minimum tax entirely, so as to encourage, investors. Because minimum tax is just a payment out of your balance sheet when you make no profit. All right. So another one is section 39, very key, subsection 1, A, high, gas utilization incentives. Now, gas utilization incentives will no longer be available to companies that are formed out of another company that has already enjoyed these incentives. This amendment will prevent instances of abuse of the tax incentive schemes. We used to talk about duplication of taxes. So this one is trying to also eliminate duplication of incentives, where you form a new company through restructuring or buyback, in downstream sector. So if the original companies have enjoyed the incentive is just about 5 years tax relief. First 3 years, initial 3 years, then 2 additional years. So complete 5. So where it has enjoyed, you now break it down to form another one. You can't,
Let's move to key changes also under the Stamp Duty, Education Trust Fund Act, Excise Duty, Personal Income, and VAT, etc. Okay. Let's talk about the changes under this too.
Okay, so now under SETA, what we call SETA, Custom, Excise and Tariffs.
Yes.
Sections 21, beg your pardon, subsection 3, says excise duty on non-alcoholic, carbonated and sweetened beverages shall be charged at a specific rate of 10 naira per liter.
Yes, sir.
So for alcoholic drinks, this is not new. Wine, alcoholic, cigarette is not new. But the government has now brought in non-alcoholic beverages into this particular bracket. And the challenge, the problem would be that as at last year, in October specifically, there was a bill called Tertiary Hospital Development Fund Bill that government was, that was passed in Senate. And right now it's at the House of Assembly, and it's also targeting certain companies within the industry, companies that produce beverages. They are targeting them to be paying 1% of their profit before tax as a special. So if investors and general public should watch this particularly, because if this thing is passed into law again, it becomes a multiple tax for companies that are producing beverages. So that's that. Then for stamp duty, one particular section here is just one section, section 89A3, say that henceforth collection of stamp duties and EMT, that is electronic money transfer levies, are henceforth to be shared among the 3 tiers of government within 30 days after collection. And for the one that's the accumulated collection between 2015 to 2019, within 30 days after the signing of this act into law, all the 3 tiers of government are meant to share it. All right, so those are the key. Therefore, Tertiary Education Trust Fund, 2 amendments there. Section 1, subsection 2, increase the rate of education tax from 2 to 2.5%. Then section 2, subsection 2 also reduce the repayment days. It used to be 60 days to pay for educational tax if you are given assessment to 30 days. This is just to harmonize with the provision of SETA. Last year it was reduced from 60 to 30. All right. So, for value-added tax.
Okay, we've talked of VAT. Let's also talk about the newly introduced taxes now. Okay. We have the Nigerian Police Trust Levy and NASENI. NASENI is National Agency for Science and Engineering Infrastructure. Yes. Can we also shed more light and understand what this means? Okay,
so now for these 2 acts, they are not actually new. For the Police Trust Fund, it was actually enacted in 2019, but it was not administered. Right now, FRS is meant to administer it, to collect it, collect the levy and account and remit. Section 4, subsection 3 says that all companies to pay 0.005% of their net profit as police levy. So the challenge here is, what is net profit? Is it net profit before tax or not net profit after tax? There will be need for more declarations, on this. Then for NASENI, what you call National Agency for Science and Engineering Infrastructure. It was actually enacted in 1992. It's not also new, but this is the first time it will be administered. And Section 20, subsection B, says that there shall be a levy of 0.25% on profit before tax of commercial companies and firms with turnover of 100 million and above, covering the banking, mobile, telecommunication, ICT, aviation, maritime, and oil and gas sector. So the challenge here is the challenge of multiple taxation as well. Because certain companies like telecommunication and ICT, they already have what they call NITDA tax. They are paying before now, which is an earmark, a special tax. So you are now bringing on them another NASENI levy. So we should watch this. This is going to be issue of multiple taxes.
Let's look at changes we expect under the FIRS Establishment Act. What are the major changes?
Yeah, the major change is number 1, Section 25, subsection 4. Talk about use of third-party technology to gather tax information. Before now, the FIRS could only use a proprietary, software, the one that they internally developed. But because of advance in technology, so that may not be able to catch up with certain technologies on company use. So they can now use a third party. If where the proprietary does not work match, they can use third party, this. But the taxpayer should note that they have right. For example, 30 days notice before FIRS can come to take the information. Okay. And they can also extend it by writing that maybe they are not ready. And if they are granted approval, then be it. But now there's a penalty that in case you intentionally and willfully, disallow them to take the information, there's an additional penalty of 25,000 every day until you're able to allow them. That's big.
That's big. Let's also look at the disciplinary measures being put in place to manage public funds. That's talking about the changes in the Finance Act. What would you say about these disciplinary measures? I think one of them is what you just talked about, 25,000. What do you think? Do you think that's the way to go?
It's the way to go because, even the Bible says where there is no sin, where there's no law, there's no sin. So if you have a law and there are no penalties, to enforce it will be very, very difficult. So it's the way to go.
Let's look at what other additional measures are introduced, or what are the additional measures introduced to manage public debt at this time, because it remains very, very important.
Yes. Under the Fiscal Responsibility Act, Section 41, subsection 1, talks about the basis on which governments can borrow. So one of them is for capital expenditure, infrastructure development and the rest. Then one of them is critical reforms that is of significant national impact. Then one of them is human development. But the question is, what is human development? Are we talking about training? So, but then specifically, government is looking at taking loans at the lowest interest rate this time. So this might affect people that are investing in bonds, in government bonds and the rest, because government, when they borrow money now, they want to take it at very low interest rate. So I believe that's one of the measures put in place.
So let's do a general overview now as we wrap up our discussions. A lot of points has been made, and very with facts backed with your details that you have with you here. What do you think, or what's your general overview with regards to the impact of FA 2021?
Yes, thank you so much. Now to government will want to generate more revenue to be able to support the 2022 budget, that is tagged budget of economic growth and sustainability. Then also, if government will be very truthful, I believe that there will be impact of such collection on infrastructural development. But this is it. Looking at the general overview of the old act, in my own opinion, I feel that the benefit government will going to take outweighs the benefit that investors will likely take, because lesser incentives were given, and you have more new taxes, multiple taxes that are being introduced. And who are paying these taxes? They are corporate organizations. So they are having more taxes to pay this year than ever before. So, but one of the things that government did, what happened this thing is just that some of the ambiguities we have in the previous act have been dealt with. But while they were doing that, they were creating other ambiguities. So the story continues.
Well, we are done, but I just remember that all of this, will it make us improve this our tax to GDP ratio that we always talk about? We are below 6%, and will this help us to leapfrog one way or the other?
Maybe a little bit, but it's not going to be a single day's journey. It's not going to be significant. It's not going to be a single day journey, because governments need to broaden, the tax base. You know, as you are trying to increase more taxes, then it should be a multiple approach, you know, mixed approach. You increase the broad, and you also, I mean, you increase the taxes, and also, you know, increase, you know, the base, the tax base, bringing more people into tax net.
That's the way to go. Yes. I've been speaking to a professional, the managing partner, Boju Professional Services, Mr. Olakpo Jubamidele, explaining to us all of the impacts and what is expected of the PIA 2021. We'll keep a tab on you, and anytime we have issues surrounding taxation and all of that, we'll have you join us on the show to contribute your quota, just like you've done today. Thank you so much for spending your time with us. We appreciate this.